Warren Buffett just predicted the unthinkable for markets, and arguably this could create a new end of the year forecast for 2024. So recently, Warren Buffett, the king of value investing and defensively the greatest investor in history, known as the Oracle of Omaha, has made some decisions that have Wall Street on edge and crypto investors ranting about it all over Twitter. Add this to the uncertainty surrounding a settlement between the SEC and Ripple as markets continue to get hammered, and XRP has now dumped to 55 cents all the way from a recent high of 65 cents. And as you can see on the actual chart, we are down from that 65-cent range down to about 54 as of right now for a 17% loss. In a typical market fashion, anything below 20% would be considered a bear market. But because crypto is so volatile and fluctuates heavily with any uncertainty in general markets, you could argue that a bear market in crypto would be more like a 50+% dump. So this is by no means directly bearish. If anything, this looks like a natural and necessary correction, right? Or a retrace of a major bull move to retest some level of support. Still, many investors are worried right now, but should you be? So what's really going on in the markets, and why am I still bullish on crypto specifically? Now, in this video, we'll be covering the reason Warren Buffett has been the subject of many headlines and talk among investors. We'll also be covering this chart that many refer to as the Warren Buffett chart and what that means for markets. We'll be covering another legendary investor, Bill Ackman, and how a recent decision may be confirming Buffett's sentiment and latest moves. And last, we'll be covering some macroeconomic indicators and the signals that they might be providing so we can get a better or more clear picture on what's happening in the markets and how that's going to affect crypto and XRP alongside some attractive buy targets if we end up dumping a bit more. Also, before we begin the video, head on over to bullrunners.com. You can find the link in the description below and subscribe to learn how to take advantage of our all market solution. So whether the market's bearish or whether it's bullish doesn't actually matter, because you can discover how to earn more crypto in less than 10 minutes per day with the very first play to earn XRP game. So if you're feeling blessed, comment 777, and if you're going to be the richest person in your family tree, smash the subscribe button. Before we dive in, a quick reminder that the opinions in this video are for informational and educational purposes only and do not constitute financial, legal, or investment advice. All investments, including cryptos, carry risks and potential losses. Always do your own research and consult with a licensed financial advisor. We are not licensed financial advisors, and relying on our content for financial decisions is at your own risk. By watching this video, you agree we are not responsible for any losses or damages, and we do not guarantee any specific results or outcomes. Some of the links below may be affiliate links, and we may earn a commission, which actually helps support this channel and helps us to create value-based videos like this. We also hold some positions in the cryptocurrencies that we talk about, but that's only because we do what we believe in. However, this should not be interpreted as a recommendation for you to do the same. With that said, let's get into the video. So markets have been getting hammered recently, and a lot of folks are starting to worry. And then you have someone like Warren Buffett coming out and actually selling some of his stock. But we'll talk more on that and whether or not it should matter to you right now. In this article from MarketWatch, it states a viral chart suggests a recession is coming after the Fed cuts interest rates, but don't panic yet. And this is something that we've actually talked about on this channel before and shared before this viral chart, so to speak. But we'll just cover what this thing says, what it means, and whether or not we are actually in for a recession, because a lot of folks earlier this year were talking about how we truly did hit the Goldilocks zone, and what that essentially means is that we avoided a recession in an environment where interest rates were extremely high. And not only that, right, but we had a yield yield curve inversion, which we'll also talk about, that is a pretty good indicator of a recession incoming. However, that yield curve has been inverted for 2 years and arguably the longest of any other time in history. So many people, right, kind of got restless and said, well, if a recession isn't coming, then we'll just continue to buy up all the stocks. Then you had something like AI coming into the market as a narrative, and the markets bought it up. Institutional players and retail investors alike bought it up and continue to just pump these stocks higher and higher and higher. And with that, right, came the Magnificent Seven and all of their major pumps. Well, that seems to be coming closer to a close now, as Chairman Jerome Powell from the Fed signaled on Wednesday that there is a potential rate cut for September. And many folks and some of the smartest analysts, in my opinion, in the space, because most analysts don't get it right, but there are a few really good ones, have stated, what difference does it make now? We see that inflation has truly cooled off, and it has. The current inflation reading from the Fed being 3% and finally starting to consistently tick down after having been super sticky since March of 2024 when everything started to, range sideways and break down in the markets. We are currently sitting down at 3% and well on the way to the 2% target. Now, the Fed has said they remain committed to getting inflation down to 2%, and they knew it would be pretty sticky, which means they had to keep interest rates higher for longer. Well, this has been quite some time now. Since July of 2023, we've remained at a terminal interest rate of 550 basis points or 5.5%. And that's squeezed a lot of leverage out of the markets. A lot of companies are no longer able to afford to refinance their debt or service their debt. People aren't buying homes and cars to the same degree, right? And so the markets have truly cooled off. But a 3% reading is not really what everyone else is seeing. When you come over to Trueflation, you can see that we've actually dumped to a major low on August 1st of 1.38%. We're currently sitting at 1.5%. So the majority of the markets and analysts all agree inflation truly has come down and that the Fed has kept interest rates higher for too long. Now, the problem with that is typically they act retroactively or a little too late, and they usually respond by lowering interest rates after a major crash, as this chart would indicate. So you can see right here, right after we had a terminal rate back in 2000 before the dot-com bubble, they started lowering interest rates a little bit beforehand, and then a couple months later recession happened. That is when they basically dropped interest rates to near zero. Same thing happened again in 2007 before the 2008 Great Recession. They started lowering interest rates a little bit, probably because they started getting some very negative economic readings, and they're like, we did it, we kept things a little too tight for a little too long, right? After everything started crashing, they said, we have to really respond by lowering interest rates to near zero. And that was actually right here for the first time. So I think we're at like 100 basis points over here. We're at 0.25 percent or 25 basis points back here. And they kept it extremely low until they continued to increase interest rates right before, guess what? That V-shaped bottom and recovery that happened with COVID. So they started lowering interest rates, and then they responded to the recession by dropping them to near zero yet again. And then when inflation got out of hand, what did they do? They started to increase interest rates to slow economic activity, yada, yada, yada. And now here we are, where things have been ranging for quite some time now, and arguably above the average in terms of the amount of time that we typically keep interest rates high. And whenever they start to lower it, it's probably not necessarily due to our inflation reading, but probably because they're also seeing the economy get really weak and they're worried that they're going to cause a major recession. Well, by the time they actually lower interest rates to near zero, and that's the only tool that they have, it's a very blunt tool at this point, what's going to happen is it's likely going to be recession time. So people are a little bit worried about that. And not only because, we've had interest rates higher for longer, but because Warren Buffett recently decided to sell a lot of stock. So, one prominent member in the crypto community, Anthony Pompliano, otherwise known as Pomp, said Warren Buffett has been selling large amounts of his stock portfolio. What do you think he is doing it, or why do you think he's doing it? Are you doing anything differently because of his sales? Many people in the crypto space don't take him as seriously because he didn't like Bitcoin at first, thinking it was a bubble, but he also didn't understand it, and that's totally fine. He doesn't need to understand everything to still be one of the greatest investors of all time, right? You can't catch every trend, and arguably what I've learned is I shouldn't be investing into something I don't understand. So if he doesn't like crypto, it's probably because he doesn't understand it. On the flip side, I think he's starting to understand Bitcoin a bit more now. But I will say I don't understand a lot of things about different companies and stocks, and so I stay away from them because if I get into them, 9 times out of 10 I'll get wrecked. And it's not like I'm stupid, right? Warren Buffett's not stupid. It's just the fact that we simply don't understand it. Now, just how good of an investor is Warren Buffett? Well, these are his A-class stock shares from Berkshire Hathaway. Very expensive shares. They haven't, I don't think, done any stock splits. I'm not too sure about that, but I mean, at a $641,000 price, I doubt they've done splits. And since back in 1979, okay, from these local lows, he has arguably one of the best performing stocks in history, aside from a few others like Monster. You would never guess, but Monster has insane gains. We're sitting at about 255,000% you would have gained over this period of time. You would have absolutely outperformed just about any other major asset class, index, you name it, just by betting on Warren Buffett and Charlie Munger, who was his recently deceased partner. Both very wise men who understand markets, dynamics, human psychology. If you've read their newsletters, listened to their audios, I mean, you would definitely benefit from it as a crypto investor. But at the end of the day, it's not like they're stupid. They really do know what they're doing. And when we look at this blue line, which is Microsoft stock from its recent all-time high, and we'll just go ahead and grab that from there. And then we look at the stock on Berkshire Hathaway over the same period of time. Berkshire is up 5%, while Microsoft, again, very large companies, we're talking trillions of dollars traded on these things in terms of volume, is down 12.5%. So there is a 20% difference, and this just goes to show that even the most important and key players in the future of technology and AI, in particular with Microsoft now, with the amount of money they've invested in their data centers, there can be about a 17 to 20% difference because of how Berkshire Hathaway is being managed and how much less risk you are taking in that. So exactly how much is Warren Buffett de-risking? So in a recent post from a guy by the name of Brian Ward on Twitter, he basically explains that Warren Buffett has liquidated $189 billion of stock. And this was actually not too long ago. That actually came in as of a March 30 filing, which means he's likely been selling through March all the way till present day. But right here, this was posted on July 23rd, right? But this isn't the end of his selling. A new report informs, however, it is likely that he's continued selling since that date. Mr. Buffett started warning that the economy was headed for troubled waters, and others warned of a massive 30% sell-off in the stock market that is inbound. Mr. Buffett's economic indicator has never been as high as it has been since it started in the 60s, and he is saying that we are approaching the worst recession since the Great Depression. Now, that is a very strong statement, right? A lot of folks thought we would see the exact same thing happen when COVID came around, and arguably we should have experienced that, right? But politicians kicked the can down the road by practicing what we call QE through the Federal Reserve, QE being quantitative easing, and that's a very fancy way to basically say we are going to flood the system with cash. And when we do that by printing these dollars, and all that means is just clicking a few buttons and sending money to banks all over the world to distribute among the citizens and businesses and to give out loans, right? Basically to prop up the economy, we didn't experience a Great Depression. What we experienced was a V-shaped recovery. So who's to say that we won't do that now? It is going to weaken the dollar. dollar? Yes. And we'll talk about that at another time. But it doesn't mean that the dollar is going to be weak relative to the rest of the world. Ultimately, if the US goes down, a lot of countries all over the world are going to go down with it, as we recently explained in a prior video, actually, I believe yesterday's video. On why we are such a powerful nation when it comes to our GDP, when it comes to our consumers, when it actually comes to our resources. We are one of the most resource-rich countries in the world. So it's going to be very hard to just have the U.S. collapse. The only way it possibly could right now is from within, right? If we have continued to have infighting. But that said, he still has over $400 billion invested in stocks as the end of March, and it appears the number is dwindling. To which he goes on to say that he sold American Express and a Bank of America stock. So that said, how much did he sell? Well, I'll pull this over right here and show you. Berkshire sold about $3.8 billion of the Bank of America stock over 12 trading days through Thursday, according to filings. Let's see here. The Securities and Exchange Commission leaving it with a 12.5% stake in the bank that would have been worth more than $35 billion at Friday's close. But the news that's got everyone just going crazy right now is the fact that Berkshire sold a net $75.5 billion in stocks in the 3 months through June, helping boost its cash hoard to a record $277 billion, including cash equivalents, the company's financial statements show. And this is actually, I believe, a new all-time high in terms of cash reserves for Berkshire Hathaway. Now, why would anyone want to sit on that much cash, right? Because at the end of the day, yes, they can go and buy government treasuries, right, and get a cool 4 to 5% on it right now. But you don't want to be sitting in treasuries if you can potentially deploy the capital into assets that are going to produce you far more income than 5%. Now, Berkshire has been a seller of stocks for 7 quarters straight. So this is, this is nothing new directly, but it is enough to start to worry investors that why would one of the best investors in history continue to sell stock in some of the biggest well-known companies in the world? To which he responds, we'd love to spend it, talking about his cash, but we won't spend it unless we think a business is doing something that has very little risk and can make us a lot of money. That is the key to investing, right? The investment icon said at the time. It isn't like I've got a hunger strike or something like that going on. It's just that things aren't attractive. Now, why is he saying things are not attractive? Let's get into an interesting chart. Right here we have what people call the Buffett indicator, which is a market cap to GDP ratio. Now, how this thing works is basically a global version of the Buffett indicator that takes the combined market capitalization of the world's publicly traded stocks and divides it by global GDP. A reading north of 100% indicates the global stock market is overvalued relative to the entire world economy. So it's kind of like one of these things where someone can say, hey, I have a net worth of $1 billion, right? But then you go and look at all of their assets, all of their economic activity, all of the value that they provide to the world, and they're really only worth 500 million. You could argue, well, no, right? The reading doesn't make sense now. For whatever reason, you're promoting the fact that you have far too much value for the actual value that you provide or have. So that said, that's what that means. Now, from Investopedia, they explain that if the valuation of this indicator falls between 50% and 75%, the market can be said to be modestly undervalued. Also, the market may be fair valued if the ratio falls between 75 and 90%, and modestly overvalued if it falls within 90 to 150%. So now let's take a look at this specific indicator in full screen. Right here you can see that this line is the midline, or the mean, being the average. Okay, we're currently sitting at an average of like 80 some percent. I want to say 85%. Okay, through the entire range of the 70s into the late 90s, we were actually somewhere in that mean range, which is totally fair, modestly valued. Okay, then we had the tech dot-com bubble in 2000, and you can see we hit a GDP ratio of, at the time, something that was unprecedented, 138%. Then we experienced a market correction and a more severe market correction in the global recession. So here we had in March of 2009 a 53% reading. So yes, things were truly undervalued. Things got sold off to record lows. People were fearful, and that's when people like Warren Buffett got greedy. But since 2009, all we've experienced is not only major rates of inflation, right? Global expansion, technology, money printing, you name it, right? And it consistently has pumped the GDP ratio all the way up, right? And we're talking again the value of publicly traded stocks divided by the GDP, up to a point where in 2021, right before the major correction in 2022, if you were around to remember that, we hit a high of 195% before we corrected back down to 140%. And you know what we had the government do? Continue to print dollars. It's like, whatever, right? Let's just continue printing dollars. And so that's typically going to prop the market up, and then you have something like AI entering the space as a narrative, and people want to buy that up too. And as of very recently, we hit about 193% for a new lower high. Again, we're at major all-time highs in terms of this one Buffett indicator. And so I could see where Buffett might himself look at this and say, okay, I've got the readings and the data in my own companies. I'm seeing that things are beyond overvalued. We're looking at this indicator too. I want to start getting out. Like, you want to sell into this strength, because at the end of the day, things can correct, and they can correct hard. Now, another major player in the game, and this guy, Bill Gross, is considered the bond king. And the bond market is one of the biggest markets in the world. Some of the smartest investors in the world play in it. He's basically says, don't buy the dip as stocks crash, while Warren Buffett's moves hint at a sell signal. Bond king Bill Gross offered a bearish view of the stock market, just as Warren Buffett also signaled less optimism. Investors should stop talking about buying the dip and start asking about selling recoveries. Now, for those of you guys who don't know what recoveries are, this is from GPT. Companies can typically buy out debt. So imagine this: if you had debt that went to collections, right, and you didn't pay it for X amount of time, then that bank might sell the debt to another bank or some sort of a company that then tries to collect the debt. So they sell the debt at a discount to just get it off their balance sheet. So we're talking bankruptcies, liquidations, insurance claims, defaulted loans, litigation settlements. In essence, selling recoveries involves the transfer of rights or assets that have been or are expected to be recovered. So imagine this: in a healthy economic environment, you would typically buy these things with the expectation that as the economy improves, I'm going to be able to collect on those debts from people that weren't previously able to do that. But what this guy is saying, Bill Gross in particular, is he's saying people are going to be in a worse place sooner rather than later. So if they're in a worse place, right, you wouldn't want to hold their debt. They're never going to pay it. So you're buying basically junk debt. Now, this is a guy who really kind of knows what he's doing here. So he's basically stating that we are in for a potential bear market. Even in his own Twitter, he says, is any media figure willing to say bear? So I'm going to hop on over to CoinGlass, and I'm going to go to the liquidation map right here, and I'm going to look at the Bitcoin exchange liquidation map. So right here you can see that we have short liquidation leverage, long liquidation leverage, and then we have all of these different exchanges. I'm not really too worried about these big old lines, so we can remove those here just so you can see how simple this actually looks. We'll keep Binance on there. Okay, so all of these orange lines are Binance longs and shorts on Bitcoin. And we're covering Bitcoin because it is mama bear of the entire crypto market. Then I'm going to put this on a 7-day time frame, because on the daily time frame things can fluctuate, right? You might be bullish one day, bearish the next, but as long as you're in and out of the market, it doesn't really matter whether we're in a long-term bear market or a long-term bull market. You're there to trade. What I'm after is a little bit longer of a period, and when you go to that 7-day period, you can see that this red line right here is the actual current price of Bitcoin, sitting at about $60,800. Okay, on the right hand side you have the cumulative short liquidations on this green line. I'll even get rid of Binance, OKX, and Bybit. Okay, on the left hand side you see the cumulative long liquidation leverage. This simply means that if for whatever reason, let's take this all the way to the far left, if we hit a price range of $53,940, about $1.47 billion of people would be liquidated. In other words, we have about X amount of people that have $1.47 billion of long positions. On the flip side, if I drag this all the way to the right, you can see that right up here we have about $6 billion of shorts in the market. That means that we have quite a big ratio difference in terms of longs to shorts. The majority of the market is short, and they're short and they would be liquidated up to the tune of $6 billion if the price hits $67,000. So in other words, the majority of the market is leaning bearish as things stand. Now that doesn't mean we are very long-term bearish, but if I come over to TradingView right here, and I put a line right there where the liquidations would occur. It was about $67,200. Okay, this is where about $6 billion of liquidations would happen if, right, the shorts were wrong. In other words, the majority of people are short right here, which has caused the market to sell off. And if the market pumped right back up here, it would liquidate them. Now, that would have to happen very quickly because this is a dynamic indicator, right? People can remove their positions. They can sell out of their positions. It can cause a bit of volatility in the meantime, but you would need a lot of money to buy Bitcoin back up into this range. On the flip side, if Bitcoin dumps to about $53,900 right here, right, and you can see how it aligns well with those wicks, well then about $1.6 billion would be liquidated. Let's double check that real quick. About $1.5 billion would be liquidated. So far more investors are leaning short, and what I've noticed is typically the market will move a little bit further in the direction of those investors, liquidate some folks, and then pump back up into a range here. So I do expect markets to dump just a bit more. And if I were looking at the chart, I would say, probably around the $58,000 level, or maybe just below that recent low right here, before we get some sort of a bounce, and then it remains to be seen what happens there. But, when you have so much weight to one side, it's kind of like a tug of war. You have far more players on one side. They're typically going to win. There are a few upsets, but more often than not, what I found is that this indicator is a pretty good signal. Now, from an hourly time frame, since that recent high of $69,000, we've consistently been getting sold off at around the 20 EMA. We failed to break out a few times, only to consistently see sell pressure and resistance at the 20 EMA line. The interesting thing that I'm noticing here, though, is that open interest has climbed with price, and that is typically indicative of longs opening at the market. So if you have longs opening at the market, it is possible and potential that we pump maybe to 62,000 before we continue trending down, but again, remains to be seen. This is a bit of a dynamic indicator. So generally speaking, we are relatively flat since this local high over here on open interest, which in this case would be indicative of the fact that people are just closing positions and not entering the market, probably don't want a piece of the volatility to begin with. So this leaves us with a few revised targets. First, I'm going to get rid of that $53,000 level because I don't think we're going to hit it just yet. The second thing I'm going to do is I'm going to drag this down to about this range here where we have these recent lows and then we broke down. So I do believe that if we continue to have longs opening at the market, market. I think people could potentially be slightly bullish. It could bring the price right back up to that $63,000 level and then potentially break back down to the $58,000 level. And so what does that mean for XRP? Well, I just don't know, and I don't think we're going to be breaking out to a new all-time high just yet. I do believe XRP is positioned to do so this bull market or this cycle. In other words, if by the end of the year things do look really hot from a crypto perspective, and we get a settlement in the SEC, I think XRP is probably going to hit its recent all-time high, previous all-time high, I should say. And so when I look at the VRVP, you can see we have a tremendous amount of support between the 53-cent range down to the 47-cent range. So I would argue this would be my major buy zone. In other words, any point in time we touch that 52 to 53-cent range all the way down to 47 cents, that's where I would be accumulating, because if anything, this to me just looks like a new higher low, right, in an uptrend, especially if we break above this trend line right here, right, for a very long-term descending triangle from a weekly time frame from this high all the way down. So if we get a new higher low right here, somewhere in the 47-cent to 54-cent range, and then we start to play with this upper portion of this trend line again, then chances are we are going to break out for new major highs. And the only thing that's got me extremely bullish as of right now is the fact that through all of this sell pressure from that recent high at $69,000 all the way to $60,000, we've seen nothing but Bitcoin be removed from exchanges. So I do believe that major investors and institutional players are looking at Bitcoin now as a hedge against reckless spending, reckless governments, inflation. They're looking at this as a true store of value and digital money like never before. And I think that's going to play into XRP and virtually all other cryptos that are good and sound assets. And finally, it does make matters better that this yellow line, by the way, is any institutional player or wallet that holds at least 100,000 to a million Bitcoins. And as you can see that this has been climbing. So these wallets, right, whoever they are, have consistently been accumulating Bitcoin in the droves. So maybe they know something that we don't. But if you enjoyed the video, smash the subscribe button. It helps the channel out. And again, head on over to bullrunners.com to discover how to earn more crypto in less than 10 minutes per day with the very first play to earn XRP game. And I look forward to seeing you in the next video, my friend.